This is the August to September 2024 Argent Wealth Management Market View. This is Matt Restuccia, the Chief Investment Officer. At Argent, our differentiation is our deep knowledge and practice of tax, estate planning, and investments under one roof. You can connect with us on all the various social media platforms. What is the conclusion? Well, the stock market is signaling the bull market is likely to continue. Inflation is on a downward trajectory, and the Fed, therefore, is likely to make its first rate cut in September. Economic indicators are on an upward trajectory, but the fall tends to be a weak seasonal time of year, so a correction would not be surprising. If we look at the stock market indicators, there are many. Here are a few. Currently, 73.4% of stocks, multi-cap stocks, all capitalization stocks, we're talking large, mid-cap, small, are above their 200-day moving average. The market tends to go up 11.5% per annum when that is the case. And demand volume is higher than supply volume. Demand volume or volume supply is the smooth total volume of declining issues, while the volume demand is the smooth total volume of advancing issues. So when demand is more than supply, the S&P goes up 11.92% per annum. And earnings estimates continue to increase. Positive revisions over the last 60 days are 75%, while positive revisions over the last year or 280 days is close to 70%. And when the 60 days is higher relative to the last 200 days, since 2009, stocks have outperformed bonds by 7.3% per annum. In just a simple chart looking at small cap stocks, the Russell 2000, the S&P 500, and the NASDAQ 100, which are both larger cap indices, you can see that as soon as the latest inflation report came out and it was clear that the Fed could lower interest rates in the September meeting, small caps rallied aggressively while large cap lost some steam, but that is healthy. Large cap had already done so much better than small cap all the way through that point. So seeing more stocks participate on the upside and investors rotate to smaller, more interest rate sensitive small cap stocks is a good sign of market health, and market health is a leading indicator for economic health. And you can see, inflation just continues to come down. It's on a downward trajectory. In fact, in the last report, the all items was flat to negative. Year over year, it's now only 2.9%. And you can see the change in what investors expected from the Fed after the latest CPI report. Investors now put 100% chance that at the September meeting, the Fed will lower rates, likely to 5.0 to 5.25. And you can see prior, or about a month ago, investors only put, a 60% chance that they would lower rates at the September meeting. Despite inflation coming down, the economy remains strong. Credit conditions, despite higher interest rates, the availability of credit to consumers and businesses is favorable. It's available to expand your business or buy a home. This measure would and has historically been on a downward trajectory before recessions began. It's currently on an upward trajectory. Recession is unlikely. And there still remain 1.2 times the number of job openings per unemployed in the United States. Companies are looking to hire and retain employees, certainly not fire. And consumers are healthy, and consumption is about 70% of gross domestic product, or GDP, in the US. So with investors having less debt, and you can see debt tends to increase into recession, we're just not there. And the trend in debt service is good. Without a recession, anything more than just a correction is very unlikely. But you can see kind of seasonally, you can see this blue line projects what an historical election year seasonal pattern might look like. You can see we've very closely, but close enoughly tracked what that has historically done. And you can see typically kind of in the fall of election years, not too surprising, um, investors get a little antsy and there might be a correction or some volatility, but that's within the context of a bull market. You can see typically the markets would rally in the fourth quarter. It's a very typical pattern. So as an investor, that doesn't mean you make a change to your portfolio. I would stay overweight stocks, but it does mean just to expect it. But you can't. It's very difficult to trade around these things, and there's no guarantee that that actually happens as well. Um, Helping to build the case that a correction is possible is just that investors are more optimistic than pessimistic, and that means that incremental good news has less positive impact on the stock market than incremental bad news has negative impact on the stock market. And speaking about the election, there's going to be a lot in the media. There's a lot of different opinions and sides people can take about what's going on. But long story short, pessimism about the president or uncertainty about the president has historically not been bad for stock markets. When it's extremely pessimistic about the president or about what's going on, that's when it can be bad for the stock market. But that typically coincides with economic shocks and not actual presidential policy or who the president is. So it's more coincidental. You can see when there's some pessimism, but not extreme pessimism, the market actually does better than when there's extreme optimism about the president. I think that's probably because when there's extreme optimism about the president, it probably coincides with an unbelievable economy. And when there's already an unbelievable economy and the market, which is a forward indicator, has already priced that in, there's not much more upside to the market from there. And that would explain why at the extremes, the markets don't do that well. And if you look at the history of bull markets and where we are, so right now we're up about 40% on the Dow Jones Industrial Average over about 450 days. But historically, these types of markets can last 3 years or 751 market days and go up 105% on average. So to get to an average bull market, there's still 60% cumulative returns on the table approximately. And another, if we're at 450 days, another 300 days, that's more than a full year. So well into 2025, this bull market could go and plenty of returns are left on the table. So stay invested. Thank you, everyone.